Gascon, and I'll be discussing the very first topic of this course, which is the treasury management itself. So based from the learnings that I've acquired during our face-to-face meeting or discussions, treasury management refers to monitoring and checking the liquidity of the company, which is basically managing the cash inflows and outflows of the business. It is using funds and revenues as effective and efficient way as possible in order for the company to be able to meet their expenses and obligations, at the same time help the company or the business grow. So based on my understandings, the importance of treasury management is it helps the company to improve processing their cash flows and manage their funds or revenues better, since it monitors their payments or obligations, receivables, interest rates, and foreign exchange rates. For example, the company has an obligation of 2 million pesos and then pays it through a check payment method. It will be then recorded to the balance sheet, as well as if they have some receivables. For instance, they have a receivable of 1 million pesos and then they have already collected it. It will also be recorded to their balance sheet so that they can monitor or check what cash goes out or goes into the company. The company also records the expenses that are made from operational or any transactions of the business. As a result, the company will be able to know if their business is running effectively and efficiently or experiencing losses, since they will be able to compare the profit, their payables or expenses through their balance sheets. So if their profit is greater than their expenses, then the business is doing great or gaining profit. But if their expenses are greater than their net profit, then the business is in danger since they are experiencing losses.
Hi everyone, this is Kimberly Manguba, and related to the topic that discussed by Fina Marie Gascon, I will also tackle about the cash forecasting. So this is related to treasury management, where cash forecasting is the process of estimating companies' cash flow in order to make informed decision about treasury management. So with this, cash forecasting involves projecting both incoming and outgoing cash flow, which can then be used to assess the short-term and long-term financial health of a business, as well as to identify potential cash flow problems. So cash flow forecast can be done on a short-term or long-term basis, as I said earlier. So short-term forecasting is typically done on a weekly or monthly basis, while long-term forecasting rather may be done annually or every year or once a year or even further out. So cash flow forecasting is typically done on monthly or quarterly basis, although some businesses may choose to forecast weekly or annually. So the accuracy of cash flow forecast will depend on a number of factors, including the stability of the business, the quality of financial data, and the ability of forecasting team to correctly identify and account for all relevant factors. So, if done correctly, cash forecasting can be an invaluable tool for making sound financial decisions. So, like for instance, as a business owner, or you as a business owner, or I as a business owner, you are constantly working to ensure that your company has the cash it needs to operate. Of course, that's very important. So, cash forecasting here is one of the most important aspects of treasury management, and it's something that you should be paying attention to. So, now cash forecasting is a great example of where machine learning can have a real impact. So, by using the historical data, we can build models that predict future cash flow for a company. So this enables treasury managers to make better decisions about how to allocate resources and manage risk. of the business entity or your business itself. So now it is important to be able to understand and explain the business value of cash forecasting. So that is crucial. So in this topic about the cash forecasting, this is how we or we can help you to keep your business running smoothly. So in other words, by using cash forecasting, so cash forecasting can be performed using a variety of methods, including financial modeling, trend analysis, and so on. While in other words, cash forecasting is really important tool for treasury management. You know why? Because it allows company to plan for unexpected expenses and make strategic decision about how to best use their available cash. So that is why in cash flow management, so the cash flow of the company here is displayed in a real-time and treasury management system and is therefore always up to date. That is in a reality. So you must follow that. So expenditures and revenues here are also clearly displayed so that those responsible can see the cash situation of the company at all times. So now this helps them to better distribute the liquid funds within a company.
I'm Mia Gatan, and now I want to discuss about working capital, the topic that I choose. Working capital management is a business strategy designed to ensure that a company operates efficiently by monitoring and using its current assets and liabilities to their most effective use. Working capital management involves tracking various ratios, including the working capital ratio, the collection ratio, and the inventory ratio. Working capital management can improve the company's cash flow management and earnings quality by using its resources efficiently. Working capital is the money available to meet your current short-term obligations. To make sure your working capital works for you, you will need to calculate your current levels, budget your future needs, and consider ways to make sure you always have enough cash. Working capital is important because it is necessary for businesses to remain solvent. Working capital is calculated by taking a company's current assets and deducting current liabilities. When a working capital calculation is positive, this means the company's current assets are greater than its current liabilities. The company has more than enough resources to cover its short-term debt, and there is residual cash should all current assets be liquidated to pay this debt. When working capital's calculation is negative, this means the company's current assets are not enough to pay for all its current liabilities. The company has more short-term debt than it has short-term resources. Negative working capital is an indicator of poor short-term health, low liquidity, and potential problems, playing its debt obligation as they become due. In real time, managing working capital is very important because it will affect your business if you cannot manage it properly. It can be down for your business or your business will be bankrupt. Working capital is computing the accounts receivable turnover ratio and then computing the days sales and receivables and also analyzing the changes in the working capital ratio from one year to another year so that you will know if business is profitable or not. And that's all. Thank you, sir.
Hi, I am Karen Rodriguez and I am going to explain about warehouse financing. What is warehouse financing and its benefits? So, when we say warehouse financing, it's a form of inventory financing that involves a loan made by a financial institution to a company, manufacturer, or processor. Existing inventory goods or commodities are transferred to a warehouse and used as collateral for the loan. Warehouse financing is most often used by smaller privately owned firms, particularly those commodities-related businesses that do not have access to other options. A failed warehousing arrangement uses a company's inventory as collateral for a loan. The inventory to be used as collateral is segregated from the rest of the inventory by a fence, and all inventory movements into and out of this area are tightly controlled. Alternatively, the inventory may be stored in a public warehouse. When items are sold from these stocks, the proceeds are paid to the finance company that is supporting the failed warehouse financing arrangement. If the value of the inventory on hand declines below the amount of the outstanding loan, the borrower must immediately pay the difference for the finance company. So, what is the benefits of warehouse financing? Warehouse financing often enables borrower to obtain financing on more favorable terms than short-term working capital or unsecured loan, while the repayment schedule can be coordinated with the actual usage of inventory or materials. Since it is secure lending, warehouse financing is often less expensive by other types of borrowing. The commodity inventory in the warehouse is contractually pledged to the lender so that if the borrower fails to pay, the lender can take the inventory and sell it on the market to recover the loan. This form of lending is often less expensive because the lender would not be involved in the lengthy legal battle to recover the loan as they would if the loan were unsecured. The commodity company can also improve its credit rating, lower its borrowing cost, and potentially secure a larger loan when utilizing warehouse financing. This offers a business advantage to similar size companies with such resources.
My name is Medja Kolyama from the group 2. So the topic that I choose is all about cash concentration. Cash concentration refers to a treasury term that involves the pooling of a cash funds from different accounts into a single centralized accounts. The term is used often together as concentration and disbursement. The cash concentration and disbursement take place to and from a single centralized treasury account of a company. What is cash concentration? Cash concentration is a treasury management method that involves the transfer of all funds from different accounts to a single centralized account. In the modern banking system, cash concentration refers to an electronic funds transfer system that transfers funds to and from different accounts into a centralized account. Such electronic funds transfer are used to facilitate online banking and transactions. So, the methods of cash concentration: when a business has several accounts, it can pool the funds into a centralized account. The cash consolidation can be performed in various ways. The automated cleaning house and online banking channels can also use in the methods of their clients. Number 1 is zero balance method. This cash balances from all accounts of a company or a group will be transferred to a main treasury account in this method. So, number 2 is fixed sweep method. And in this method, a fixed account is transferred from all sub-accounts to the main treasury account. If there is insufficient balance in any sub-account, the transaction takes place when cash is available. Number 3, target balance. It is also called the minimum balance method, in which sub-accounts keep a target balances and transfer the funds above the target to the main account. Number 4, percentage method. A fixed percentage method is a total cash available in each account is transferred to the main account. Number 5, investment sweep method. Businesses can use the investment sweeps to transfer cash balances to investment instruments such as term deposits. However, this method requires special arrangement with banks or investment funds management companies. So how does cash concentration work? Cash concentration and disbursement are important treasury management methods. A business may generate cash flow from different sources and keep the cash balance in a different account. Centralized treasury management will pool the cash funds from different accounts into a single centralized account. The businesses can use the centralized cash balance to fund different investment activities. It helps treasury management easily disburse funds to sub-accounts when and wherever needed. So the advantages of cash concentration. Here are some key advantages of that. Number 1, it reduces the dependency of short-term financing and improve liquidity. Number 2, business can use consolidate funds for large investments. Number 3, it helps businesses in quick funds and disbursements. It also helps ACH to clear funds and electronic transfer rapidly. So the disadvantage of this is centralization of cash funds can be costly. Funds disbursements to different sub-accounts can delay group payments. Centralized cash means less autonomy and economic stability to sub-accounts. Number 4, it may pose a liquidity risk at the sub-accounts level. So, for the conclusion, cash concentration is very important treasury management tool. It helps centralize cash management for quick pooling and disbursements of funds. It reduces the dependency of a short-term financing. So that's all. Thank you.